Hello everyone. In this video, we are looking at Crocs' last 5 years of performance based on financial statements from 2020 to 2024. If you are a visual person like me and you don't like to look just at numbers, then this video is for you. Quick note, this is just an overview of Crocs' past financial performance. You will need to analyze further on certain points which will be stated but not covered in this video. I was looking for a stock to invest long-term, that is when I noticed Crocs around November 2024. At that time, the stock had declined by 20 to 30% from its 52-week high of $159 per share in June 2024, and its PE ratio was around 6 or 7. Despite this drop, the company had an impressive financial performance over the last 5 years. Hence, I started to analyze further to identify the right price to pay for the stock. If you look at the revenue chart, the first thing you'll notice is the consistent growth in revenue over the past 5 years. However, the growth rate has been declining. I understand that as companies grow larger, their growth rate naturally slows down. But in the case of Crocs, it's still only a $3 to $4 billion company. So, either 2024 was just a minor setback, or they're facing a roadblock that could keep them stagnant around the $4 billion range. When factoring revenue growth into stock calculations, I would take a conservative estimate of 3% to 8%, but that's just my opinion. More than 50% of the stores are in the US, which I believe is a good thing as it indicates room for growth in other countries. We can see that most countries are increasing their number of stores, except for Russia. However, we should be cautious about drawing conclusions based solely on this data, as it may not provide a complete picture of individual markets. It would also be helpful to have the average sales per store over the last 5 years to better understand same-store sales trends. I was unable to find credible data on average sales per store or individual market revenue, so if you come across any, please share it with us. Crocs has two sales channels, wholesale customers and direct customers. Sales from wholesale customers increased during the first 3 years but have remained stagnant over the past 2 years. We need to assess whether this stagnation will continue in the future. Direct customer channel has been consistently growing for the last 5 years. However, growth rate is dropping, which is expected as the company grows bigger in size. Crocs has two brands, Crocs and HeyDude. The first thing I notice is that sales growth and the growth rate for Crocs have been consistent over the past 5 years. Although there was a slight dip in the growth rate in 2024, an 8 to 9% increase is still impressive. HeyDude, an Italian shoe brand acquired by Crocs in 2022, saw a 13% decline in sales in 2024. However, this data alone is not enough to draw conclusions about HeyDude's overall performance for the year. To further analyze both brands, we have data on the total number of units sold and the average price per unit for Crocs and HeyDude. Interestingly, for Crocs, despite a consistent increase in the average price per unit over the past 5 years, unit sales have also been growing. This could indicate stable or increasing demand for the brand, but further research is needed to confirm this. For HeyDude, the decline in average price may have led to higher unit sales in 2023, while the subsequent increase in average price could have contributed to a drop in unit sales in 2024. However, it's important to note that we only have 3 years of data, and HeyDude was acquired just in 2022. I believe the company has been in the process of restructuring its business, so we will need to put a timestamp here to analyze the next year's performance. Now, let's shift back to the financial statements, starting with gross profit. Crocs has a steady increase in gross profit. Gross profit growth rate has declined for last 4 years, which I think it will stabilize around the 8 to 10% range. We will have to check that with the next year's sales performance. Crocs has an impressive gross margin of 50 to 60%, which is higher than the industry average for apparel, currently at 51.93%. The cost of goods and services saw a sudden increase in 2022, likely due to the HeyDude acquisition, but has since stabilized around the $1.7 billion level. Moving forward, I expect it to keep pace with gross profit, as it's typical for apparel makers that as gross profit increases, the cost of goods and services rises accordingly. I believe more research is needed to determine an ideal growth rate, understand the sudden increase in the cost of goods and services here, and analyze why it has remained at the same level for the past 3 years despite consistent growth in sales and gross profit. Net income has been consistently increasing except for 2022. You'll need to research further to understand the reason behind this setback. However, considering the company still generated a decent net income, it appears to be a minor issue. The yearly net income growth rate saw 2 impressive years with over 100% growth, but has been declining since. That said, a 19 to 20% growth rate for net income is still strong. Additionally, the net profit margin remains solid at around 20%, which is significantly higher than the industry average for apparel, currently at 3.15%. It's important to monitor free cash flow, as it shows how much money a company has available in its financial cycle to spend on other initiatives. Personally, I prefer companies with free cash flow that is slightly higher than net income. For Crocs, free cash flow closely follows net income, which is a positive sign. As the company grows, free cash flow is expected to align more closely with net income. While the growth rate is declining, similar to other charts, the margin remains strong at around 20% in line with net income. Determining a consistent yearly growth rate for free cash flow is challenging with the available data. Since this is a key metric for stock valuation methods like discounted cash flow (DCF), I would suggest using a conservative estimate of 5 to 10%. Cash flow from operations has been consistently increasing. Cash spent on investing activities has remained stable over the past 5 years, ranging between $50 million and $100 million, except for 2022. I believe this spike was due to the HeyDude acquisition, which was also valued at approximately $2 billion. Looking at the total debt chart, we can see that the company took on debt in 2021 and 2022, some of which may have been used to finance the HeyDude acquisition. To determine whether the entire acquisition was funded through debt or a combination of debt and stock issuance, we will need to check the number of shares outstanding. Over the past 2 years, the company has also started paying down its debt. When financing activities show a negative cash flow, it indicates that the company is using cash to pay down debt, repurchase stock, or distribute dividends. Currently, Crocs does not pay dividends. The next slide will provide insights into the number of shares outstanding. The $1.5 billion in 2022 represents the amount of debt raised, as shown by the increase in total debt from 2021 to 2022. Crocs has been actively repurchasing its stock, buying back approximately 18.5% of its shares over the past 5 years, a significant amount and positive news for investors. Based on this slide, we can conclude that the $2 billion investment in 2022 was financed through a combination of debt and stock issuance. To conclude, here are my final thoughts on Crocs. Please note that this sheet reflects only the range of past performances and does not predict future outcomes. These ranges don't account for any future business plans or strategies where the company might anticipate higher or lower growth compared to its past performance. So, why are we using these ranges? Because a growing company like Crocs will generally aim to perform at a similar or better level than in the past. By using these ranges, one can get an idea of the potential value of the stock. There are lots of stock models to determine the value of a stock. For this video, we are only using Graham's and discounted cash flow model. The EPS growth rate in the last 5 years for Crocs is at 74.39%, but I have taken a conservative estimate of 3, 5, and 8%. Based on these estimates, the potential value of the stock is shown. If you think the values could be higher or lower, please use your estimation to recalculate the value of the stock. Similarly, in discounted free cash flow calculation, a growth rate of 3, 5, and 8% is taken for free cash flow growth rate. Based on those growth rates, the potential value of the stock is shown. Again, if you think the values could be higher or lower, please use your estimation to recalculate the value of the stock using DCF calculation. Thank you for watching this video.